Greetings, everyone, and welcome to our May 2024 quarterly macro and market update with our Chief Investment Officer, Michael Dow. I am Julien Frazeau, your Deputy Chief Investment Officer at Beacon Pointe, and it is my pleasure to be your macro and market moderator today. So we've got a lot to cover, but before we bring Michael in, just a couple of housekeeping items. We budgeted up to 90 minutes for this webinar, and we have more than 60 slides to cover. We also get a lot of great questions from our audience, and we want to make sure that we have time for Michael to address as many as possible. If you do have a question, please type it into the Q&A box at the bottom of the Zoom screen, and we will address it throughout the course of the presentation. Also, note that we are making a recording of this webinar available at beaconpointe.com/videos approximately 48 hours after the conclusion of today's live event. Okay, so what's on the agenda for today's call? As usual, in the first section, Michael will talk about the global growth outlook. In the next section, we will discuss the US economy, the election, inflation, and the Fed. In the third section, we will talk about the Federal Reserve R-star. What is R-star? Actually, it represents the theoretical interest rate level at which monetary policy is neither accommodative nor restrictive, meaning it neither stimulates nor slows down economic growth. In other words, it is the interest rate that prevails when the economy is operating at full employment and stable inflation over the long term. And you'll see that it is a moving target. And as usual, we will wrap up the webinar on how to position portfolios in the current environment. But before I bring Michael in, let's set the stage. The equity bull market that started in October 2022 is very much alive. Yesterday, the S&P 500 notched its 23rd record high in 2024, and bond yields fell heavily after that. Data showed the consumer price index cooled for the first time in 6 months, reinforcing bets that the Federal Reserve will cut interest rates as early as September. Okay, we have the stage set now. So, Michael, without further ado, the floor is yours.
Julien, thanks for that introduction and that stage setting. It's been an interesting investment period, particularly for the last 6 quarters, as we've tried to navigate what is a very unusual economic environment, yet a very positive, for the most part, investment environment. It's been risk on. Bond market volatility has been high. Equity prices are, as Julien said, record highs. So let's just try to dig in and see what it is that we can discern from the existing data we have, and how do we see the markets and the economy evolving going forward. But before I start on the slides, the first one I want to address is this. A lot of times we have conversations about investment themes and things that are happening in the market, or sometimes even geopolitics, and a lot of things can, I guess, get in the way of truly investing and achieving investment objectives, whether you're a private client or whether you're an institutional client. There's a couple of things that matter most. Where we are in the economy. What's the economy doing? Is it in recovery? Is it in recession? Is it an expansion period? Where are we? Are we heading towards a peak, or are we heading towards a trough? So identifying where you are in the business cycle is terribly important. Understanding the dynamics of inflation. If you can suggest that inflation is going lower and interest rates are high, that tells you a lot about where you should be positioned. Tells you a lot about what tells you all you need to know about what the Federal Reserve is going to do. And if you didn't know anything about investing for the last 15 or 18 years, knowing what the Federal Reserve is going to do would be one key factor that you'd want to address. And last, and certainly not least, when thinking about the equity markets, is what are developments in corporate profits? Are corporate profits growing? Are we headed for an earnings recession, et cetera? So these are the things that matter, and these are the things, primarily the economy and inflation, that the Fed cares the most about. So looking at the Fed, looking at corporate profits, you can got to get a handle on where things are headed. I'll start with a couple of ideas. I wouldn't even call them conclusions, because we can't conclude our assessment of the economy and where we are in the cycle until the Federal Reserve starts lowering interest rates. Until they normalize the interest rate environment, you can't declare a soft landing. But the current data currently point towards a soft landing or a no landing scenario. The economy is chugging along. There may be some cracks in the consumer, but right now, a soft landing is what is priced in to both equity and bond markets. The Fed's done raising rates. There's a very small probability that they could actually hike rates between now and the end of the year. That would only happen if inflation continues to reaccelerate higher. We had a relatively good inflation print yesterday, which takes some of the steam out of the recent 3 or 4 prints that were way above expectations. So I think it's safe to say the Fed's done raising rates, and that 5% is probably the peak in 10-year yields, which would be very beneficial for a position of a longer duration position in the bond market. Taking a little extra risk and interest rates will be rewarded if we've seen the peaks. And corporate profits are not only resilient, but they seem to be on pace. There's more than 400 companies have reported in the second quarter. And it appears that growth rates of corporate profits are in the 5% range, same as what we saw in the fourth quarter, and on top of an 8% bump in the first quarter. So corporate profits are quite resilient. If you're looking for an explanation for why the stock market is where it is, it has to be a combination of the expectations of future rate cuts by the Fed. That's always very beneficial, or generally beneficial to the stock market, and very strong corporate earnings. So the answer to these questions: where are we in the business cycle? What are inflation dynamics doing, and how will the Fed respond? And how are corporate profits evolving are really not just the main things, they're almost the only things that you need to know when thinking about how to position a portfolio. And starting with the conclusion, I'll say the positions we've had on for the last 4 or 5 quarters are the same we have on today. So we're sticking with a value over growth. We've got a slight, I wouldn't even call it slight, it's almost a non-existent overweight now to international equities versus US stocks. We had a slightly larger overweight, but that was when we thought the US dollar was going to depreciate. Our view on that has evolved. So value over growth, US and international about even. And where we're taking some risk is in the bond market. Having a value overweight and maybe a little bit of a tilt, maybe into international, is probably causing the portfolios to trade at a little bit of a lower beta than 1 to the equity market, which is why we've got our little dial here, slightly underweight equity market risk and slightly overweight bond market risk because of the interest rate exposure we've added to the portfolio by taking on a long duration strategy. In any event, and especially in periods of time when you see such high correlations between stocks and bonds, generally bonds will provide a good hedge and offset the risks of the equity market, but only when they're not as highly correlated as they are now, meaning that when bond markets sell off or stock markets sell off, you'd expect the bond market to pick up the slack. Well, right now, correlations between stocks and bonds are near record highs. As a result, alternative investments tend to do really well in that environment, and they're a good strategic allocation in any event. So private equity, even private real estate in the current market, and there's questions about particularly commercial office space and how to manage that. I'd say a diversified real estate exposure, primarily multifamily and industrial, as opposed to commercial office, probably the way to go. Although there are bargains now in commercial and office, there's no such thing as a bad investment or a bad asset. There's just bad prices. So as long as prices have started to readjust to the realities of the interest rate market, you can start to evaluate and sift through some of these areas, particularly in commercial real estate, that have underperformed recently. So having an allocation to alternatives is always a good idea. It's an even better idea when you have high correlations between stocks and bonds, and we'll see that. The biggest message I can deliver is the one we as a team, our investment committee, our research team, has basically coalesced on the last 6 quarters around the idea that we just don't know where we are in the business cycle. It's a very, very unusual post-World War II recovery. It's been affected to a great degree by fiscal stimulus and significant monetary policy support, for which we are now dealing with the aftermath. That's high budget deficits, high debt levels, and frankly, a very large Fed balance sheet, which has now come down, and a very accommodative Fed, and then a switch about 2 years ago to an incredibly tight Fed. So all of these cross currents are are causing, and in addition, I'll make one final point. In addition, not knowing where we are in the business cycle, because all of the metrics that you would normally look at, all of the economic data that you would look at, it isn't coalescing around one quadrant in the business cycle. It's spread out. And we'll see that in one of the charts coming up. So bottom line, when you have a substantial amount of uncertainty about where we are in the cycle, what the next move for the Federal Reserve is going to be, and we're getting more clarity on that as inflation moderates. But given the uncertainty level and frankly, valuations in the US equity market, I think it's terribly important to just, and there's no shame in being neutral risk. So you want to stay closer to home. Neutral risk doesn't mean no risk. Neutral risk means neutral to whatever your risk profile is, 70-30, 60-40. Doesn't mean going to cash, doesn't mean when you're on risk on going 100% equities. That's not the way investors do it. What you really want to do is make sure you're just kind of staying close to home right now, and the portfolios are. So that's the summary. We always start with a little bit of a global growth review. These are the PMIs from JP Morgan, the purchasing manager, or activity indices. The orange one is services. So global services, any reading above 50 is an expansionary reading. And that's really hooked up very nicely, especially since the Fed pivot. We'll talk a lot about the Fed pivot. That means what the communication strategy of the Fed was back in November, December, it switched pretty meaningfully from hawkish to dovish. And that was the pivot that the Fed made from a restrictive policy communications-wise. They haven't raised or lowered interest rates in the last almost year and a half or plus now. But they haven't changed interest rates, but they've changed their communications policy, and that's what pivoted. So they were hawkish, now they're more dovish. The December 13th, I think, FOMC meeting and the press conference afterwards were kind of a shocker to us on the investment committee, because it did seem like maybe Jay Powell was getting ahead of himself from a dovish standpoint, talking about the next move might be rate cuts. But that has launched, in large part, if you think about the contributors to the stock market rally in the last 4 or 5 months, good corporate profit growth is one of those reasons. But the other one has to be the expectations in the marketplace for Fed rate cuts. They went sky high 5 months ago, and they've come back down to earth, but yet the stock market continues to rally. So the Fed pivot certainly had a lot to do with the equity market rally, and probably pushed out any kind of an economic slowdown a quarter or two, because as the equity market rallies, that loosens financial conditions, and as financial conditions loosen, future economic growth rises. So we're just taking a look here and seeing that the global economic activity, the situation there is very positive right now. Both manufacturing PMI is above 50 and the services PMI well above 50. And there's no red here in any of the heat map on any of either the global developed EM or any of the individual countries that we're following. It's just kind of humming right along, Goldilocks almost. Here's what's happening in global monetary policy. It's not coincidental that economic growth globally has been supported by non-U.S. central banks, including emerging market central banks. But now there's divergence. So now what you're seeing here, by the way, is the developed market rate hikes and rate cuts, and orange is the emerging markets rate hikes and rate cuts in the last year and in the last 3 months. And very recently, what you see is emerging economies, particularly in LATAM, are cutting rates fairly convincingly, and you're starting to see it in the weighted average central bank rate of over 9%. It was about 9.25% last quarter. It's coming down because the emerging economies need to, they've done what they needed to do in terms of quelling inflation, and now they need to support their economies, whereas developed markets remain steady. So this divergence in central bank policy between the emerging markets and the developed markets has implications not only for global growth outside the U.S., but also for the U.S. dollar. And this has maybe a lot to do with why we've moderated any kind of a international equity overweight, because when the U.S. dollar is depreciating, that's good for international equities. And our view a year ago was that the U.S. dollar was likely to depreciate because the Fed was likely to start cutting rates before our trading partners. But now it looks like the ECB and the Bank of Japan and the Bank of England are likely to start cutting rates sometime this summer. And if they do and the Fed doesn't, that isn't dollar negative, that's actually dollar positive. We have higher interest rates in the United States versus our trading partners. That incentivizes US dollar denominated investment, and investment in US dollar denominated assets causes the dollar to appreciate. So as long as interest rates remain higher for longer here in the US, the dollar is not likely to depreciate materially. And that's what we're seeing. And one of the reasons why we take a look at global central banks is terribly important for both global growth and for the outlook for the US dollar. I want to talk about US debt sustainability, because a lot of folks are concerned that the response to the COVID shutdown starting 4 years ago now has caused the US to do some significant damage to our fiscal and debt sustainability. Our fiscal situation is much worse. This is debt to GDP going back to the 40s. Our debt to GDP ratio peaked at about 126% back in 2020, early 2021. It's never been that high before. It was as high as 119% in the immediate aftermath of World War II, when we were spending, much more money than we were earning in taxes. So plug the hole with a budget deficit and an increased Treasury issuance, which seems to be on offer again. I visited with some folks at the Congressional Budget Office a couple of weeks ago and got a hold of their recent, which anybody can on the CBO website, recent outlook for the debt is not good. Based on their baseline projections, we're likely to see a reacceleration of debt. And so we need to address it. We need to address debt. And there's a couple ways to do it. Our original thesis was maybe financial repression would be the way to do it. What we need to do is make sure we can get debt back down towards 100% of GDP, and then hopefully back closer to 60 or 80%. That would give the U.S. a lot more fiscal degrees of freedom. That is, once the debt level's very high, it's hard to bring fiscal stimulus to bear. You can't, you just don't have that flexibility because you've already reached, maybe, we don't know where the maximum level of debt is, but maybe you've certainly gotten closer to it when you're at 120% debt to GDP versus 80. When you're at 80, there's no impact on growth, generally speaking. It doesn't have any impact on decision makings for households or corporations or investors. But at 125%, you got to question whether what you're getting paid on U.S. Treasuries is the right amount. Because at these levels, you have to start to worry about the fiscal and debt sustainability issues. So we're very focused on this. It's a large part of how we've been thinking about portfolios for the last 3 or 4 years. And it's an important consideration when thinking about interest rates and, frankly, the desirability of the U.S. as an investor haven and as a place to put money. I don't think there's any concerns at this point about whether the debt levels are unsustainable. They will need to be addressed. They need to be addressed in next year. Next year is going to be very impactful for fiscal policy, and we'll see why in some coming slides, because we are going to spend a bit of time on the election because this might be an impactful election from an economic and fiscal perspective, more so than in recent history, and I'll talk about why. There's more fiscal data here. This is the debt to GDP chart you saw in the prior. In terms of budget deficits, we've achieved a much better outcome than we saw in 2020, 2021, but still we're running budget deficits, which increase the debt level. The real important factor on this chart is the interest paid on the debt, and we're going to talk about it on the next chart as well. Interest paid on the debt doesn't matter when your debt levels are low, or even if debt levels are high, if the interest is low. So when you get high debt levels and then interest rates spike up as they've done, then you have a potential debt sustainability problem. And as it stands right now, the dollars paid on interest, the combination of the total government debt, which is closer to, above 34 trillion now, and the interest rate on debt, which has doubled in size, it doubled in the rate from 1.5% to over 3%, combines to show to calculate the interest paid on the debt in dollars. And what you see is going from 2023, we paid $650 billion in interest costs. That's going to triple between now and 10 years from now on current trend. And in fact, come next year or the year after, we might see $1 trillion worth of debt service payments. Interest cost on the national debt might achieve a very significant and not good milestone of $1 trillion. which will be much more than our defense spending budget. It's approaching, some of the entitlement programs. I mean, this level of interest payments is the key feature. It's not, even when we had high debt levels 5 years ago, it didn't matter because interest rates were so low. But because of the spike in interest rates, now the administration, the new administration, the new president, and the new Congress, starting in 2025, they're going to be forced to deal with it. Here's why, and I thought this was a really important slide, so I put a big star on it. And what this slide shows, going back to the mid-'80s, is the percentage of interest costs to total tax receipts. That is, tax receipts come in from tax revenue for the government. The government spends it on everything the government spends it on, including defense, non-discretionary items, healthcare, education, et cetera. And what do you have? And interest costs. And when the percentage of interest costs of the total tax revenue that comes in the door reaches a particular threshold, and that threshold is deemed to be 14%. Every time we've hit 14%, whoever's in charge of the purse strings, the government, the president, and frankly, Congress, mostly in charge there, is forced to go from stimulus to austerity. So while we've had this Goldilocks period since 1997, where interest rates were low enough and the debt levels were low enough that those two things combined to keep interest costs below this 14% threshold, you could allow for fiscal accommodation. Now you can't. So the constraints on fiscal policy are about to be tested, and for the first time in 35 years. So it'll be it's a new world for the first time since 95, 96. So 30 years ago, the next administration is going to have to deal with much less accommodative fiscal policies. This will be very challenging for both this government and for the new president. Julian, do you have a question?
Yes, I mean, we had 35 trillion of debt now, and it kind of doubled in the last 10 years. So why could it double again in the next 10 years and still be okay?
How can it double again and we could still be okay? Could you repeat that?
Yeah, I mean, if you look at like the slide before 11, we really went from, we doubled in 10 years, basically.
Yeah, sure. Yeah, we did. I mean, in 2010, we were at 60% debt to GDP. That's correct. That's the great financial crisis plus COVID response. Every time we've spent more money than we've taken in, it's caused a budget deficit. And every time you got to plug the deficit with an increase in the national debt. Why didn't it cause a problem? Is that the question? When it doubled, and why can't we double again?
Yeah, I guess not as a percentage, but more as a trillion dollar number.
Okay, the dollar amount. Okay, okay. Here's the issue there. Whether you double, quadruple, or 10x, use Matt Cooper's phrase, the debt doesn't matter. If you have, because what you do care about, it's not 35 trillion that matters, it's what's GDP. GDP is what the government will use to pay down that debt. So the ratio is all that matters. I mean, we could go from 120% debt to GDP back down to 80 and still have significant, and still go from 35 trillion to 50 trillion in debt, as long as nominal GDP grows. So that's the key. And that's an excellent point, and I'll get to why that's excellent. Does everyone understand this chart? I mean, this chart I think is really important. The constraints on the next administration are large. But here's why debt matters, but it's not going to be a crisis, at least in the near term, for the United States. What is all of this on? It's kind of a busy slide, but know this. When you're looking at maintaining your debt sustainability, whether you're a household, in this case, this is Sovereign Credit Research 101, as a government, all you need to know is if your growth in nominal GDP is greater than the average interest cost you're paying on the debt, as long as your budget remains relatively stable, particularly the primary budget deficit, as long as the primary budget deficit remains reasonably stable, you can continue to maintain high levels of debt as long as nominal GDP, that is the growth rate, and this goes back to the original question, what if we double, the debt? Doesn't matter. Tell me what GDP is doing. And this is the formula. All you need to know, like in a couple of months ago, the growth rate, the nominal GDP growth rate was close to 6%. And what the interest we were paying on the debt was 3%. Now, this number is going to go up. The interest we pay on debt is likely to increase, but not a lot because it takes a long time for the debt to roll over from the low interest. I mean, if you issued a 10-year bond 4 years ago, it was issued at a 0.75 coupon. We got a lot of very cheap debt out there, and we're going to continue to have a lot of very cheap debt. The average cost of debt is likely to increase from 3 to 4% plus or minus over the next couple of years. This outlook for them, the CBO, is close to 3, 3.25, 3.5. So it might get to 3, 3.25, might go to 4. We don't know. But the point is growth, nominal GDP growth remains higher than the interest costs on debt. So when you see these orange bars pointing up, that's growth is greater than the interest rate paid on debt. When you see the orange bars pointing down, growth is less than the interest rate on debt. This is the key factor for debt sustainability. As long as we have nominal growth rates above the interest cost of debt, we'll be fine. Everything's a trade-off, though. If you try to implement, if you go back to this slide, which tells you that the next administration is going to have to be more austere, more austerity, less accommodative fiscal policy, that means lower taxes, whatever. Lower taxes are good for growth, but they're bad for the budget. Higher taxes are good for the budget, but bad for growth. So there's this trade-off. There's this constant tug of war between taxes and the budget. Nobody gets elected by raising taxes. So you're going to have to do something, but you're going to have to cut something. The only way to deal with our debt problems, by the way, is to try to fix the entitlements, which are non-discretionary. And that's just really hard to do. The last point I'm going to make on this slide is growth is key here. As long as growth, and this goes out this is the CBO projections out to 2034. For the last 40 years, we've had about a 1% cushion of growth over the interest rate paid on the debt. And that's been good. That's why we've been able to maintain debt sustainability. We should continue to maintain something just under that for the next 10 years. But this is highly sensitive to growth rates, primary budget, and interest costs. Final thing, this is how we are either going to maintain or lose our reserve currency status. We're not going to have a debt crisis as long as as long as nominal GDP is higher than the interest rate we're paying on the debt. But a debt crisis would mean that interest costs are rising faster than growth. So as long as we can maintain, confidence in the US dollar, which we have done to date. And by the way, you need somebody else to raise their hand and say, I want to be the reserve currency. I have all of the credentials necessary. That doesn't exist. There is no substitute for the US dollar. Not today and not in the next 15 years. Maybe 20 or 30 years from now, but not right now. Julian, did you have a question?
I think you pretty much answered the question, but I guess one was about the U.S. government actions possible to reduce the debt, other than reduce spending.
Well, raise taxes, reduce spending. That is fiscal policy, 101. The way that governments generally deal with the debt is something we've been talking about for several years now, which is financial repression. That is, you let inflation run hot. So think about this. And again, it goes to that, if debt goes from 35 to 50, as long as GDP goes from 28 to 50, then you're okay. Nominal. So nominal GDP is a function of real plus inflation. So the way that the government is likely to deal with the high levels of debt, and the way we're going to go from 122 where we are today back down to 100 and then below, is through inflation. We're going to liquidate the real debt burden by letting inflation run at 2.5%, which seems, based on the conversations I've had with some of the economists that used to work at Treasury that I talked to, and frankly, the Fed policy officials that we have contact with, that seems to be the likely outcome. 2.5% inflation for the next 3 to 5 years. Julian.
Yeah, so on the same topic of austerity, so one question was is Argentina, does it give any insight into austerity in a modern age? I mean, is the US becoming Argentina?
No. No, I was in Argentina 5 or 6 years ago, and I ended up at the Ministry of Finance. And talking to the deputy finance minister in Argentina, the question he asked me at the time was, why am I not, this is 7 years ago now, why wasn't I buying Argentine? I was a bond trader and a bond manager at UBS. Why am I not buying Argentine bonds? And the answer was, because your monetary policy makes it difficult and challenging to buy debt in your country because you never know when a hyperinflation is going to occur. And I got a lot of pushback on that. So the Central Bank of Argentina, the government of Argentina is lost in a pre-monetarist world where they don't fully understand it. And Argentina and Argentine bonds have been in default more than they've been in, frankly, in current pay in the last 75 years. So no, Argentina can't really tell us much about how to. It's a heterodox monetary policy country and a country that is got an inflation problem that they can't acknowledge is partly related to money printing, which is what you do when you're a populist. Julian?
I was going to say that's the difference between a country that has a reserve currency like the US, or to some extent Europe and Japan and the rest of the world.
That's correct. And you can issue a lot of debt, and that debt can be held by foreigners as long as it's in your local currency. So some of these countries in LATAM and emerging economies in Central Europe and in Asia are trying to develop their own government bond markets where they can issue in their own local currency. That gives you a massive amount of degrees of freedom. The reason Argentina had a debt crisis that culminated in the biggest default in sovereign debt history in 2002 is because they issued a lot of debt in US dollars. And when their currency exploded because of poor economic and currency related policies, particularly money printing and hyperinflation, they were unable to pay back their US dollar denominated debt, and they were shut out of the international bond market for 15 years. Okay, Argentina, haven't talked a lot about that. That's a good one. Let's dig into the U.S. economy. And there was a question that came in before the webinar today that suggested maybe the U.S. was headed towards stagflation. I'm not seeing a lot of signs of that. But I want to remind everyone what the Fed does and how the Fed actually manages the economy. So the Fed's easy to understand if you break it down this way. They either want to keep inflation at 2%, and they want to maximize employment, which means they want to support the economy when we're heading for a recession. So what's the primary function of the Fed now? Are they worried about unemployment? No, because unemployment is near 50-year lows. Are they worried about inflation? Yes. So the Fed has to fight inflation when it was peaked at 9% a couple summers ago. Now we're at 3.5 plus or minus. The Fed needs to continue to push inflation lower. It will be just fine if they don't hurry up the project and allow inflation to run at 2.5 to 3% for the next quarter or two, and then from 2.25 to 2.75, whatever. As long as it's above kind of like call it 2.5 on average for the next couple of years, that will go a long way towards fixing our debt problem. It really will. But the Fed is going to continue to fight inflation. They do it by raising short-term interest rates, which causes, the cost of funding of the U.S. economy to rise. When you raise short-term interest rates, the equity market generally goes down like it did in 2022. The Fed started raising rates in March of 2022. So that's how they do it. And by lowering economic growth in the future, they take the pressure off the bottlenecks in the economy that occur when the economy is running hot, and they take the pressure off the labor market by raising the unemployment rate. And once you take the pressure off the labor and goods markets, prices come down. That's how they manage the economy. No more complicated than that. Here's what the outlook is, by the way, going forward. Here's GDP growth. It was ripping higher in the second half of last year, 4.9 in the third quarter, 3.4 in the fourth. We got a 1.6, and that caused everybody to start worrying about stagflation. 1.6 is not stagflation. 2% is the speed limit of the economy. So the numbers and this is the blue chip economist forecast. They're down to like less than a 30 or a 30% chance of recession now. They were closer to 65 or 70% a year ago. But look at this outlook. This is Goldilocks. And the consumer is doing just fine so far. This is the consumer's orange here. These are personal consumption expenditures. Consumer is just fine. Maybe there's some cracks. We'll take a look at it. And GDP has been incredibly resilient. And here's the GDP forecast we just saw. This is the Goldilocks. You got GDP, you got an economy on the left, you got inflation in the middle, you got Fed funds over here. This looks great. Everything looks great. Nothing to see here. No signs of stagflation. Inflation's coming down towards the Fed's 2% target a year from now, per the blue chip economists. And you don't get anything close to a recession. You get kind of just About potential GDP, 2% inflation, and normalization of interest rates, maybe starting sometime in September or November of this year. I mean, it looks great. Where are we headed, though? This is a key question, by the way. Where is the Federal Reserve normalizing to? We're going to spend 10 or 15 minutes talking about R star in a second. Is R star 4% or is the neutral rate of interest 2.5%? Used to be 2.5. If it's 2.5, then at 5.5, which is where we are today, the Fed is really restrictive. Very, very tight monetary policy. If R star is 4%, the Fed's not that tight. And the economy has survived and thrived even at very high interest rates. How has it been able to accomplish that? The answer is the neutral rate of interest may have risen. You just don't know where it is. It's not observable. So we'll talk more about R star in a sec, but there's no signs of stagflation currently. This is the heat map. It takes all these economic data points, which kind of point to where you are in the business cycle, and tells you, these are the leading economic indicators. These are financial conditions. These are macro data points, and these are primarily market observable data points. Plus, you got inventory to sales and a couple of consumer and home builder sentiment indices. Putting it all together, it kind of tells you, where you've been and how things are evolving. I mean, credit is the one thing I'd highlight here. The credit index, which talks about the willingness of banks to lend in particular, and whether the investment grade corporate bond market is open, et cetera. The corporate bond market's open, but banks are starting to tighten lending standards. So what you're seeing here is a lot of yellow and green, mostly good stuff, but this is worrisome to me because credit, can sometimes be a leading indicator. Banks sometimes stop lending before a recession. They certainly stop lending during. But there's a lot of complacency in the markets right now. Equity market volatility, historically low. The S&P 500, another record high. The dollar kind of sideways. Investment grade and high yield corporate bond spreads, record tights. Well, almost record tights. So the cost of funding the U.S. economy is very low. And that generally points to, think about it. Equity prices high. That's a low cost of equity funding. Corporate bond spreads tight. That's a low cost of, debt financing. When debt and, corporate finance 101, net present value of a project, if the hurdle, if you can achieve, higher cost of, if you have lower cost of funds, then a lot of projects that you would take on start to look very attractive and have a positive net present value. That's the point of financial conditions indices. It's the cost of funds of the U.S. economy. And the cost of funding in the U.S. economy, even with 10-year yields at 4.5, they're a little below that now. And with other financial conditions, with the stock market where it is, the cost of funding in the U.S. economy is very low, which is why we've continued to have some very, very robust and consistent economic growth, and why we probably will for another quarter or two. I think a slowdown's coming, but I've been saying that for a while. So taking all of those data points from the prior slide and putting them on a stylized business cycle gets you to what I think is the most interesting factor in the last couple of years in this recovery. They're not aggregating in expansion or recovery or trough or peak. They're all over the place. Labor market's strong, maybe it's weakening. Interest rates are looking like peaks. Credit spreads are very tight, so it looks like everything's expanding very nicely. Stock price is very high. New orders are very strong. Consumer sentiment is strong. Home builder sentiment is strong, and consumer sentiment, which is pretty volatile, seems very highly correlated, by the way, to both gas prices and the equity market. One's going one way, the other's going the other. I just don't know where we are in the business cycle. Labor market could be weakening. Financial conditions are easier. Sentiment's recovering. Inventories are not stretched. And manufacturing activity is solid. That looks Goldilocks to me. And that's what the backward-looking data suggests and some of the forward-looking financial conditions data. So I think we might have dodged a significant recession. Certainly we have so far. Maybe the recession line is down here. So where are we now? Maybe we dodged a recession. A soft landing can't be ruled out. It's not the base case, but it can't be ruled out. The Fed has certainly tried their hardest to slow the economy. They've raised rates 11 times, over 500 basis points in the last 2 years. At the same time, they're tightening financial conditions and liquidity conditions by reducing the size of their balance sheet. So over here, you've got your Fed funds, the 11 rate hikes. And over here is the monthly change in the balance sheet of the Federal Reserve. You had one blip here when the Fed a year ago during the SVB or Silicon Valley Bank and the regional banking crisis response was to inject more liquidity in the marketplace. And so the Fed expanded their balance sheet by $300 billion in 1 month, but that's all come out, within the next 2 months. So right now the Fed's balance sheet is about $1.5 trillion lower than it was at the peak. But they're going to start to slow it. Some might say they're slowing quantitative tightening by reducing the amount of runoff in the Fed's balance sheet because they've done enough there. Another thesis might be that it's, an election year and you can start to, take the foot off the gas pedal because they've done a lot already. I'm not so sure if the political thing has anything to do with it, but one of the things that has kept all of this tightening from causing a recession has to be this notion of a sluggish monetary policy transmission mechanism. Julian may have a question, so let me just finish up on that one by saying rate hikes don't matter if you have a 3.5% mortgage and you don't move. Rate hikes don't matter to you if you're a corporation that issued debt in 2020 and 2021 at 3%. You don't care that you would have to issue at 6.5% now because you don't have to issue debt. You've termed your debt out. But ultimately, you're going to move out of your house and take on a 7% mortgage, maybe. If we're still at 7% mortgages when you move in the next 12 months, probably won't be, probably be lower, but maybe it's only 6%. Still, you're going to pay double than your 3% mortgage. Same with corporations. Eventually, the due date comes and that bond matures. That 5-year bond you issued in 2019 at 2%, 2.5% interest cost or coupon, you're going to have to roll it into a 6.5% bond, something like that, maybe 7% if spreads widen. Point is, there's been this governor on monetary policy's transmission into the real economy, and that governor is the moat that borrowers have around their lower interest rate debt. Okay, so just quickly, what's different about this business cycle? Excess savings, we've talked a little bit about that with all the stimulus from 2020 and 2021, checks directly into consumers' pockets. Loan forgiveness, which ended 6 months ago, ton of fiscal spending, which caused the budget to blow up and the debt to blow up. Immigration has been hugely positive for economic growth in the last 18 months, probably underappreciated to a certain extent. What hasn't been underappreciated and maybe ultimately viewed as maybe a mistake, I don't know, is the Fed dovish pivot when they started talking about rate cuts beginning in November and then ratified at the December FOMC meeting. So fourth quarter of last year, this Fed pivot has caused what I would consider is the primary cause of the equity market increase. And by the way, and this is key, and it's hard to understand why this is important, but you've had very, very low corporate default rates but that doesn't mean there's not some stress underneath the hood. Certainly there is in some real estate markets that are exposed to variable rate lending, but all of the corporations that have fixed rate debt are A-okay. And they've been able to sort of restructure and so liquidations are come down, but restructurings are increasing. But that's been positive for the economy. When you have a lot of liquidations, that tends to throw a wet blanket on the risk taking. Julian, do you have a question?
Yes, I'm going to preview the next slide on employment with a question regarding the large amount of retail and tech layoffs that we've seen recently. Does this impact the outlook for employment going into year end and into 2025?
No, not really. I mean, tech hired a lot of people in 2020 and 2021, and so they're just right sizing. Wall Street does the same thing. They overhire and then overfire. So broadly speaking, we don't look at individual sectors of the labor market by industry. We look at the overall labor market, which remains pretty healthy, but slowing. So you got, for example, here's the most recent non-farm payroll numbers, 175. The average for the last 3 years, or actually 10-year average, is close to 160, 170. So we're at the 10-year average, but it's slowing from the recent growth in jobs that we've seen over the last 6 months. So the 3-month moving average is still very potent at 270. Here we are at 175. The SOM rule we've talked about. Basically, if you get an increase in the unemployment rate of 0.5%, from the last 12-month low to where you are today, you almost always get a recession. We were almost there. We were heading straight to a recession until the Fed pivot. So we got kind of a reprieve. The SOM rule is not pointing to a recession right now. Julian?
Yeah, another question that's related to employment is, how does immigration help the economy?
So economic growth is equal to growth in the labor force plus total factor productivity, full stop. So immigration means growth in the labor force, and that will generate economic activity. In fact, one of the things that challenges the U.S. is the birth rate here has gone just under approximately replacement. So the U.S. demographically, the United States isn't going to grow in population internally. Will grow because of immigration. Now, immigration is a hot topic. It's not that the economic implications of immigration are not controversial. You'd like to have a policy, I think, of immigration where you were able to find productive workers that come across and want to work, whether through HB1 visas and financial and tech companies or other lower income jobs. It doesn't matter. If you come over here and work, you're contributing to the GDP. And most immigrants work. That's the important thing to remember. In fact, they're coming here to work for the most part. Not coming here for any other reason except for a better life for them and their families, generally speaking. It's a better place to be. Everyone wants to live in the United States. I do. So that's the key. GDP growth this is a tautology. It's an accounting formula. GDP growth equals growth in the labor force, whether homegrown, babies that turn into 18 and 20 and 25-year-olds, or immigration, either way, plus total factor productivity.
Michael, I think you're touching on a subject that's a bit touchy, because now I get a few more questions regarding immigration, legal or illegal.
Yeah, we're not, this isn't a political conversation. So understand the economic implications and the policy implications of immigration are not controversial. If you're here in this country and you're contributing to the GDP, I'm not making any normative statements. I'm making a positive statement. I'm not saying how it should be. I'm saying what is. And what is people working contribute to the GDP. Full stop. So we'll leave the political stuff aside, because it doesn't help me manage the money, and it doesn't help you manage the money. You can have a different view about it from a political or a cultural perspective, but I don't. I just think about what it means for the economy. Speaking of the economy and the consumer, which is the biggest part of the economy, has been supported pretty meaningfully with excess savings. How do you define excess savings? It's just the savings that were greater than what the trend growth in savings would have been without all the checks that got written and sent out to households. So it peaked at $2 trillion. U.S. consumers had $2 extra trillion. By the way, I don't have our charts on this yet, because this is a paper that was just published by the San Francisco Fed about a week and a half ago. So their conclusion, by the way, is that excess savings, which has been very supportive of the economy and the consumer and consumption, peaked at $2 trillion and now has gone zero. That is, look at all the positives here. That's a couple of stimulus checks. That's a couple of stimulus checks right there. And then it got paid down. This is all support to the U.S. economy right here. But it's faded. Now maybe it's zero. In fact, the San Francisco Fed has basically said their estimates are that the pandemic era savings have been fully spent. Fiscal stimulus was a big deal. It's much less now. This is huge fiscal stimulus when you have 14%, 12% budget deficits. Budget deficits, these are CBO projections. Budget deficits are still going to be large going forward. But again, as budget deficits are fine as long as the interest rate you're paying on the debt is below your growth rate. So strong fiscal stimulus has turned into something less supportive. So what's it mean? It means that the consumer in particular is starting to see a little bit of stress. These are delinquency rates on credit cards and consumer loans. Back in the GFC, credit card delinquency rates peaked at 7. We're at half that. So while the rate of change is large, the level is still very low. Same for all consumer loan delinquencies. We're at 5%. We're still half of that for the great. But I mean, this is a lot of stress. So I think these numbers are meaningful, and they're starting to be a little troubling. That is, at some point, if you can't borrow any more money, which is the U.S. consumer has always been known as the hedonist of last resort. We're a consumption-based economy, and we'll do it debt-fueled if we can. And as long as people have jobs, they don't have to, borrow too much. But I think the unemployment rate's likely to tick higher. And as the unemployment rate ticks higher, and as the consumer is tapped out and we're starting to see delinquencies, then this is the credit index thing we saw on the heat map. The credit index is likely, people are going to, the credit provision process, whether it's to households or corporations, through bank debt or consumer lending, you shut that off and the economy will slow dramatically. So this is a kind of a canary in a coal mine. I talked about financial conditions already, so I'm going to skip that. I will just say this financial condition loosening that began in November, this is the result of the Fed pivot. The Fed says they're going to lower interest rates, and the equity market goes from 42 to 5,200. It's been a wild ride, but that's what happened. That's the Fed pivot right here. And with looser financial conditions, that supports the economy going forward. We still have an inflation problem. We'll get the next release in a month. Yesterday, we got a CPI number that basically said core is 3.6, and it continues to tick lower. That's good news. The Fed wants to see core CPI lower. They really care about PCE, and which is personal consumption expenditure deflator, specifically the PCE core number, ex food and energy. The headline CPI number, which has bounced around because food and energy prices have been volatile. You take food and energy out, and the more sticky or the more durable inflation number is still 3.6, but the headline number is a third of what it was back in the peak in the summer of 2022. So we're getting there. Again, back to the debt sustainability and how to liquidate our mountain of the national debt. Inflation's a pretty good way to do it. And no one, it's hidden. It's a secret way to beat inflation by debasing the dollar. Purchasing power is reduced. People don't like that, but it's kind of unseen unless you have, this kind of a spike of inflation. But this will be very helpful for getting getting debt lower. I want to make sure we understand that inflation is really the key to the Fed's outlook here. And we're looking at both year-over-year numbers and then the 3-month annualized numbers. The year-over-year is the trend. The 3-month annualized is momentum. And right now, if you're looking at PCE core, this is the Fed's preferred measure. We'll get another print here in a week or so. The year-over-year number is 2.5%. It looks pretty good. In fact, the 3-month, the momentum is lower than the year-over-year. So that suggests that, there's some downward pressure on PCE. Unfortunately, Jay Powell's been focusing on CPI supercore. That's core services ex housing. And momentum is going the wrong way. Right now, the year-over-year number is back up to close to 5%. We were on a nice downtrend right before the pivot. Actually, it was a little before the pivot. This is summer of 2020 or beginning of 2023. So we were on a pretty good downward trend on supercore, but the last 4 or 5 prints have hooked upward. Not good. So the momentum is higher than the trend. So that suggests that maybe there'll be upward pressure on supercore for another couple of prints. We'll see. It's going the wrong way. Momentum's not good on supercore, but it looks okay in PCE core. I still think the Fed's going to cut rates a couple times this year, most likely. And the market is expecting 3 rate cuts in the next 12 months. So you could get 1 in 2024 and 2 in 2025, whatever. But if you don't get one in September, you probably won't see one till December, because the Fed won't single a rate cut the day before the election, probably. So you got a meeting in September. You got a couple meetings. You got a meeting in July, September, November, December. You'll probably get a rate cut in September and probably December, unless the inflation numbers continue to, go against the Fed's outlook. But right now, I mean, at one point when the Fed started hiking rates, there was 11 rate hikes priced in, 11, and we got 11, exactly. So right now it's 3 rate cuts. It used to be 7, and last month there was 2 rate cuts priced in. So now more rate cuts are getting priced in. Might be up to 3.5 rate cuts today with some of the trends that are happening. I want to summarize and jump on to something else because we're already 50 minutes in. The economy is likely to slow. This is the investment committee's view. It's probably going to slow by the fourth quarter. Between now and then, probably run around 2%. So I do think you're going to get a slowdown in the economy because higher interest rates that we saw for a couple of months at the beginning of this year are likely to bite. And I think also the inflation prints that we saw from January through April or through March, the April print was okay. That was yesterday's. The December through March inflation prints are going to be looked at as maybe anomalies, a little bit of an outlier. I think it's going to continue to trend downward towards 2.5. And as a result, the Fed's going to cut maybe 1 to 2 times in 2024, but 2 to 3 times in the next 12 months, probably. So slowdown's coming, but you can't rule out a soft landing. This economy has been baffling. So I would just say stagflation is just a tail risk. It's not something we would think about. I'm going to spend 5 minutes talking about R star because I think this is really important. R star is the destination for the Federal Reserve, and it sets the positioning of current monetary policy, either accommodative or restrictive. If you don't know what R star is, the neutral rate of interest that Julian defined at the top of the hour, it basically is the destination for the Fed. It's the normalization point of interest rates. And the real R star, not including inflation, has been calculated by the HLW model, Holston, Laubach, Williams. This goes back to the 60s. It used to be 4% real, so 6% nominal. During the Great Moderation, it was 5% nominal, so 3% real, 5% nominal. And now it's like, maybe 50 basis points to 100 basis points. Post GFC, it's averaged about 1%. So call it 2.5 to 3% nominal. So 2.5-ish kind of is a good nominal expectation. Where is it now? I mean, if 2%, if it's 2%, which some people think real R star is 2% now, not 1%, then that means nominal will be 4%. R star is the landing strip. It's where the Fed's headed. And it tells you if the Fed policy is tight or not. I'm not going to read this. This will be in the book. It basically talks about how to determine the real rate of interest, but in the long run, it's the supply and demand of savings in the real economy. So here's where we are today. Nominal Fed funds is 5 3/8. That's the midpoint. 5.5 is the upper. So 5 3/8. Are we going to 4%, which is might be the new normalized R star, or are we going to 2.5? The point I want to make on this slide is simple. R star is unobservable. It's one of the most important things that the Fed can try to identify and manage. And they manage the economy based on setting the rate at 5 3/8 in relation to the neutral rate of interest, or R star. So they think if they're looking back to the last 10 years, they look exceedingly tight because nominal R star is 2.5. Is it 4 or is it 2.5? If it's 4, the economy suggests that it might be higher, much higher than 2.5 because the economy has not slowed, even with high rates of interest. So now you're at 4%. Is it 4? It's probably somewhere in between, but let's assume it's 4. It's this uncertainty about how tight or loose monetary policy is and where the destination for the Federal Reserve is that contributes to the uncertainty in the investment environment. It's why you'd want to be neutral risk right now, is because not only does the economy look a little asynchronous, but the Federal Reserve doesn't have the roadmap they used to have. They're circling the plane, but they don't know where the airport is. Julian, do you have a question?
I was just going to preview the next section on the election coming.
Okay.
With a few questions, I guess. One is on which president or political party you think is best equipped to manage the economy in the next 4 years. And another one, related to that is how much do actually they understand about the economy, the basics of economy?
Yeah, good question. There once was I did a survey of like how many economists, PhDs there was in Congress, and there was one in Congress in the House, but he retired in 2018. How many lawyers? 60% are attorneys. So fine. The government is not best equipped necessarily to make normative economic judgments, but they're in charge of the practical, how it works. So as long as they surround themselves, the president and the staff that works on the Hill with folks that understand cost-benefit analysis, will be just fine. So it isn't really so much the president that directs it. The president has very little influence on the overall economy. Who he or she picks as the Fed chairman matters, and whether or not the president is willing to get involved in interest rate decision-making, which you hope they don't, because that's political and that's bad, because you have, the incentives of the president, whoever he or she may be, to goose the economy heading into an election, whether it's a midterm or whatever, is very, very strong. And we've proven here in the United States it's a bad way to do it. We did that in the 70s with Arthur Burns as the Fed chairman and Richard Nixon. Right now, by the way, just to put this doesn't matter. It's a toss-up from a national perspective, but it doesn't matter because it's not a popularity contest. It's electoral college math. These are the 6 states. By the way, did you have a follow-up, Julian, that you wanted to ask or no? Okay.
I can ask it later, but it's related to the election. So go ahead.
Got it. All right, let me see if I can cover it. I'm only going to spend 5 more minutes on the election because it's way early. Anything we decide about policy going forward is going to change when we do this again in August. August, we'll have a better sense of where we're headed, both from a policy and a politics perspective. These 6 states, this is all that matters. Who wins Nevada, Arizona, Georgia, Pennsylvania, Michigan, Wisconsin? That's it. And in fact, interestingly, if you look at the Electoral College votes that each state has, there's been a shift from basically the Rust Belt. I'm in Illinois, but Michigan, Pennsylvania, Ohio, West Virginia, all these states appear to have lost Electoral College votes because they've lost population, whereas the population gains have been in the Sun Belt. California lost one too. Everybody's moving from California to Texas, by the way. So this is key to understand. Since the last election, the Dem states are down 1, and the Republican states are, that is, of the states that went Democratic or Republican in the 2020 election, if you redid it, the Democrats would have won less, which would have put Biden at 305 instead of 306. So there you go. Here, the next two or three slides basically goes through what happened in, how close was it in Pennsylvania, Michigan, Georgia, et cetera. And the answer is there was about 1.2% difference. And here's where the last 6 or so elections have been. Here's 50-50. These are battleground states, and for a reason. They are razor thin. 19 electoral college votes in Pennsylvania, 1% difference. 15 in Michigan, almost 3% difference. Wisconsin, less than a percentage point separated the two, 10 electoral college votes. Less than 0.5% in Arizona, 11 electoral college votes. In Nevada, 2%, and here's the tightest one was Georgia. 16 electoral college votes, 0.2% separated the two. It's a high wire act here. Julian?
Yeah, one question about the Fed independence release. How much pressure will Chair Powell feel from Biden in the run-up to the election?
0. What Joe Biden would like Jay Powell to do and what Jay Powell actually will do are 2 different things. The Fed jealously guards its independence because that's how they maintain credibility in the long run. In the short run, if the administration, the Federal Reserve reports to Congress, not to the president. The president gets to pick the chairman, and the president gets to appoint the board of governors, but then they're approved by the Senate. So Congress really is in charge of the Fed, and they have done what they were supposed to do, which is grant the Fed independence and then let the Fed do what the Fed does. And the Fed has done a great job. That's part of the reason why we're the biggest economy in the world and the most productive and the greatest, greatest stock market, most, free, why we're the reserve currency. If you start to interfere with the Fed's independence, we won't be the reserve currency for very long. Follow-up question on that, Julian?
Yeah, and just political question again. At the end of 2025, the individual tax provisions in the Tax Cuts and Jobs Acts will expire. So, how should you think about your portfolio? And would you take profit before that because you're expecting higher rates?
Probably not. Because you don't know what's going to happen. We're going to get to that in a sec. Let me get through the next 2 slides, and I'll get to policy differentials between the two because taxes is huge. Taxes in 2025, it'll be the most impactful year for taxes since the tax code was the tax law was written in 1913. By the way, here are the 6 states in terms of polling, and they're all leaning red right now, but it's still way too early. So who's ahead in Pennsylvania? 19 electoral college votes. Red team 42.9, 41.0, so up a percent, almost 2%. It's a toss-up in Michigan. All of these most of these states are within the margin of error, except for Nevada and Georgia. Nevada and Georgia at this point in the race, and it's way early. It's May. I mean, we won't know until October, really. So I have it there for interest. But here's an interesting chart, I think. Basically, kitchen table issues generally decide elections. And then I'll show you this 13 key factors that a Professor Lichtman who's correctly published or predicted every single election in the last 40 years. This guy's been really good. He's got 13 keys to the election. I'll show you those in a sec. But I mean, this is what it boils down to. If you can fill up the tank and it doesn't cost a ton of money and you still have a job, you might go with the guy that's in the White House. So during the Trump administration, inflation was incredibly low. I think this is the issue right here. For the current administration, if you're thinking about why they might have difficulty, especially difficulty going here, thinking about the unemployment rate still being near 50-year lows, fine. The unemployment rate's really low, but everything costs more. Gas has actually come down, but food costs a lot more. So going to the grocery store is challenging, and it's a challenge for the Biden administration during the campaign to try to turn that around. But at the current, this is on the left CPI inflation, on the right the unemployment rate, highlighting the fact that how much it costs to eat and put gas in the car and whether you have a job is generally a pretty good indicator of popularity. Okay, so this is Professor Alan Lichtman from American University. He actually correctly, in my opinion, picked all of the last 10 elections, having done a pretty deep dive on the Florida election in 2000. He picked Al Gore to win in 2000. So he's 9 of 10 in terms of actual who took the presidency. But it's not completely uncontroversial that Florida would have gone to Al Gore if there was a complete forensic analysis of the votes. There was no time for that, and thankfully we had a peaceful transition of power. But here's Professor Lichtman's 13 keys, and where they lean. I just thought these are his views right now. Where for example, party mandate. After the midterms, the Republicans picked up a couple of seats in the House. That's at the midterm, so boom, that goes red. There's no serious contest for the incumbent party, no, so that leans to the incumbent. And frankly, you get a vote just because you are the incumbent. All of these things taken together, you can kind of sum them up. And I think they're very interesting. They'll be in the book. You can look at them in detail if you like. These are Alan Lichtman's views, not mine. So Dem or lean Dem, Republican or lean Republican, 7 to 5 with kind of the short-term economy indeterminate. If you get a recession between now and November, it'll probably be bad for the incumbent. There's a lot of other variables. I wouldn't say there's too many other variables. These are great variables to look at, and it's interesting. Doesn't tell you who's going to win necessarily, but it has been predictive. This is a different kind. We are really, really a split country. We're 50-50 this country in terms of electoral college votes. So hard to say. Let me talk about the policy differences, because frankly, the only reason I care about politics is because it affects the policies that are promoted, not implemented, and the durability of those policies. So what are the policy differences between the two candidates? Actually, trade policy, there's not a lot of difference. Joe Biden did not repeal any of the Trump-era China tariffs and just put a few more on. Business as usual trade deals and engagement, I think, is his policies. Wouldn't have anything to do differently. Trump has announced that he would push for much higher tariffs on China and an across-the-board 10% tariffs, no matter where the point of origin. So both candidates have established, I think, the position of engaging. Really, what you're talking about is the speed of deglobalization. I think Trump would accelerate deglobalization, whereas another Biden administration would likely be business as usual and kind of continue challenging and disengaging where possible using tariffs and other methods. Federal Reserve policy, this is big. I think. Trump has talked about reducing the Fed's independence, and Biden would likely reappoint Jay Powell. Just as a Fed watcher, I prefer Fed independence. I think it's better for markets in the long run. Could be better for growth in the short run to lower interest rates when inflation doesn't necessarily allow for it. But here's the key. It's going to be taxes. Tax Cut and Job Act, all of the individual tax provisions sunset in 2025. Strategists, one of the research firms we subscribe to, suggests that 2025 will be the most consequential year for taxes since the tax code was invented in 1913. You got $3 trillion in provisions that are expiring. You're going to have a debt ceiling and a fiscal cliff in the middle of the year. And because of some of the things we've talked about earlier, the 14% interest cost versus tax revenue, the U.S. is going to need to move from stimulus to austerity, given the higher debt servicing costs. So what are the policy priorities? Don't know what's going to get implemented. No matter what you hear between now and November 6th, I think is the election, it doesn't matter what the campaign speech says. So the 60% tariffs, whatever your side or the other side is promising, it doesn't matter. It's what can be implemented that matters. And to implement a significant part of your policy priorities or your legislative priorities requires control of Congress, and not just a majority in the Senate, but 60 votes in the Senate. That's it. If you don't get 60 votes in the Senate, or you have, even if you have a unified government, all red or all blue, if you don't get 60 votes, and no one is thinking either party will get 60 votes in the Senate, it's hard to implement significant policy procedures. Okay, so I think that gets us to the final slide on politics, which is very simple to summarize. Doesn't matter who the president is, stocks go up. The president doesn't have a great deal of influence on economic policy. This election, there's wider policy differences, I think, than in a lot of cases. And frankly, the tax situation for 2025 makes the control of Congress maybe just as important or more important than the president. Because the control of Congress, that's where legislation gets passed. The president can talk about policies, but Congress will act on them. So I don't want to talk about cash that much, except to say if we get any question, is there any further questions, Julian, about, I hope not, on the election?
Well, this question I think you addressed earlier, but about, where will the austerity measure come from?
They won't. It'll be a compromise. Here's where it'll probably come from. Austerity, either raising taxes or lowering expenses. Lowering spending on services is very challenging. Raising taxes is even harder. What you have in 2025 is the expiration of these, over $3 trillion in tax cuts that were enacted in 2017. So it's going to be, here's what's going to happen. You're not going to get all 3 trillion, if they all expired, would deal a pretty significant blow to the deficit. So you're not going to get 3 trillion expiring. I was at the Center for Responsible Budget Deficit in DC a month ago at a conference related to the TG's Tax Cut Job Act, TCJA, and the sunsetting and the plans. And all the plans are compromises, because it'd be nice if we could compromise on important issues like tax policy. And so the Congress is going to have to work together. It may take a crisis. We may not get anything done. You got to get started right now in tax policy if you want to get it done by 2025. So both teams are working on solutions. They're working with not only staff, but folks at, for example, the think tanks and academics that are trying to figure out what the best solution is. So austerity is going to come in probably in the form of less sunsetting of the tax cuts, which in effect means, a worse budget situation. It's going to have to get paid for somehow. So we don't know yet, but you just know that it needs to get done. And once Congress realizes that, then we'll see some work on the budget and the national debt, because it's coming. But it might take a short-term, blow up in the interest rate markets, or China or Japan or somebody going on strike from buying U.S. treasuries or something. There might be a short, but that'll be a short term. That'll get Congress's attention, and then we'll have something done. So I don't worry about the wiggle so much. I just worry about the trends.
Yeah, there was another question about potential President Trump taking over the Fed, and I guess I addressed that one online. I think it was a reaction to a Bloomberg column about on the topic,
Yeah.
and the answer
Yeah,
is
I
basically
would, that's totally unlikely. It is totally unlikely. It was a Wall Street Journal article actually a week or two ago about how so secret, whatever. It's not going to happen. The market riot that would occur would immediately, if it's because you got to float the idea first. The market riot would cause, I think, cooler heads to prevail on that. You don't want to interfere with the Fed, and you certainly don't want to try to remove Jay Powell. He's got the seat until I think May of 2026 as chairman. That's when his term expires. You try to remove Jay Powell because it's not known whether the president can legally remove the Fed chairman. Yeah. Never been tested. It'd go to the courts, and it would cause a market riot.
But even in a scenario of a fight, it's only 7 out of 12 of the FOMC members that are elected by the president, and only 2 will come up between 2025 and 2029. So that's,
yeah, some will
worst
retire.
case scenario, it would be 2, and otherwise you have to change the law.
Yeah, so, all it takes is a couple, and some people will retire just because their terms expire or don't, most people don't stay for 14 years, which is the term. So you don't know how many shots at, reappointing Fed governors you're going to get in your 4 years. All it would take would be a couple. And if you try, in May of 2026, if you replace the chairman with somebody that has less of a independence, less independent minded, I think that would be very bad for the U.S. economy. It would be very bad for monetary policy. It would be very bad for the U.S. dollar. It would be bad for our reserve currency status. Let's see. We're going to run out of time pretty soon, Julian. So let me blaze through a couple here. If we're going to summarize everything we've talked about, it has to come back to portfolios. And I think it's fair to say that the value and quality type, if we think we're going to get an economic slowdown, value and quality are likely to outperform. And non-U.S. may slightly outperform the U.S., but we think that's less strong of an opinion now because the Fed doesn't look like it's going to cut rates faster than our trading partners. And that's the key to the U.S. dollar. Is the Fed on hold for a little bit, on hold meaning at higher levels for a little bit longer than the ECB and the Bank of Japan and Bank of England and Bank of Canada? The answer is yes. And those other central banks, which we are seeing significant central bank divergence now, the other central banks are cutting rates. That'll be dollar supportive, which will be a headwind to non-U.S. stocks. Expect interest rates to move lower with a slowdown. But here's the key. Alternatives should be part of your portfolio strategically. They should do particularly well when you have high stock bond correlation. So let me just show the correlation. We're near a record. This goes back just 10 or 15 or 20 years. The average is negative, right? So the average correlation of stocks to bonds suggests that, they're a good hedge. For 20 years, stock bond correlations were broadly negative. And why? Because the average CPI was very low. When inflation is high, correlations rise. So as correlations have risen, as inflation has been more persistent. So as inflation comes down, you should expect to see bonds become a better hedge. In the meantime, alternative assets will do pretty well. We're in the longest bear bond market in the history of bond bear markets. Which one should I say? We're in the longest bond bear market in history. It's been almost 4 years since August of 2020. We had a couple others in 58, 54, and the big one in June of 1980 lasted 6 months. And the maximum drawdown on this one is over 17% in this bond bear market. During that period of time, in the last 4 years, if you invested in active core bonds, you're down 10%. High yield corporates were up 8%. Long treasuries were down almost 40% since that moment. We like long treasuries now because yields are higher. Anyway, been a very unusual bond market. And bonds have some mean reverting properties. Poor performance equals higher running yields going forward. And if you've got sizable real yields, this is just a breakdown. 2 weeks ago, 10-year yields were trading at 460. The composition of the 460 is 240 of break-even inflation. That's expected inflation. And then the green is the real yield. Negative real yields are no value. There's no value in bonds. We had negative real yields for 2 or 3 years here. But now for the last year and a half, 2 years, we've had real yields that are in the green, that are green in the positive bucket. So that's why bonds are attractive, because you have positive real yields. And if you start with, and you want to know what bonds are going to do for the next 5 years, one of the things you can look at is the current yield. And the current starting yield of the ag index right now is just under 5%, which means this is just a regression analysis that shows the starting yield, which here we are today, and then the subsequent 5-year returns. And not surprised, this is like the slope of this line is like 1. So what that says is the starting yield is a pretty good indicator of what your future expected returns in bonds are. So we like bonds. Question, Julian?
Yeah, would it be wise to lock in a multi-year CD, like 2-3 years at current rates?
Sure. I mean, if the choice is cash or a 2 or 3 year instrument, then yes. Why? Because we think interest rates are going to come down. And if you're in cash and you're earning 5% now, and cash yields are 3% a year and a half from now, which they could be, very easily could be, then your average return, your yield is not your return. Your average return on that entire investment will be closer to 3.5 or 4%, not 5. So if you can, but I wouldn't buy a CD anyway. CDs, cash and CDs and bank deposits and cash-like instruments, those are for funding short-term known expenses or liabilities that you have to fund. They're not retirement assets. So don't put CDs in your retirement. Segregate your cash and then let your retirement portfolio be managed for the long run. That would be I think the insight there.
Another one on the same topic of bonds. What is your view on prioritizing TIPS over bonds or nominals?
So yeah, TIPS do well in 2 environments: when real yields are high, which they are now, and when inflation expectations are low and rising. That is, TIPS are priced based on expectations for future inflation, not for inflation today. So if expectations for future inflation are for inflation to come down, so that would be a negative for TIPS. We don't have a TIPS exposure in the portfolio now. We did 3 years ago. 3.5 years ago, inflation expectations were very low. And our view in the investment committee was inflation expectations and realized inflation are likely to rise, especially given all the monetary stimulus and fiscal stimulus. So I would say now is not it's not a compelling buy right now. Nominal bonds are better. We like nominal bonds. We like a little bit of interest rate duration. You don't want to buy 15-year treasury bonds. Buy 3-year treasuries, because you'll be rewarded as rates come down. By the way, here's equity market factor returns. Quality, momentum, U.S. growth have all beat the S&P. Large has beaten small. You just compare the 2 blue boxes, and obviously growth has crushed value and minimum vol, which are kind of value-y anyway. But I think risk assets will continue to do well if you don't get a recession and if the Fed starts normalizing rates. There's some info in here about AI and the Magnificent Seven returns since the Fed pivot. It's been very good, but I think valuations now remain quite stretched. So I'll just kind of summarize and go back to the very first slide, and then we can open up to another couple of questions and say, look, risk assets are going to continue to do well if we don't get a recession and if the Fed slowly normalizes interest rates. So we remain neutral overall, taking a little bit of risk out of the equity market by being overweight value versus growth. We think that's likely to perform well in a slowdown. And the bond position, long duration we have on, is likely to do very well if we get a slowdown or a recession. And you should always have a bunch of alternatives in the portfolio, 20%. They do particularly well over longer periods of time. Give up the liquidity, take the excess return, take the liquidity premiums that you get, and know that alternatives tend to do really well when correlations between stocks and bonds are high. With that, let's open it up to more questions, Julian.
Yeah, perfect. The next question was actually about alternatives, and considering the state of the commercial real estate market, what are your thoughts on private real estate debt as an alternative investment?
Private real estate debt should be okay. Private real estate equity should also do better now going forward, because like I said earlier, there's no such thing as a bad investment. There's just bad prices. And what we saw in 2022 and 2023 was the fastest Federal Reserve rate hiking cycle in 40 years. And that did damage to any sector of the market that was exposed to adjustable rate debt. And real estate and in commercial real estate in particular are highly exposed to adjustable rate debt. So that's where you're seeing a lot of the write-downs and the gating of interval funds and the inability to get your capital out, which you don't want anyway now because it means a forced sell at, you know, markdown prices. What you want to do is recognize that investments in real estate, investments in any private asset, you're getting paid more for that asset. Your expected return is more in these assets because you're willing to give up liquidity and let the manager work it out. So just to put a fine point on it, real estate is not homogeneous. It's very heterogeneous. There's commercial real estate, office, there's industrial, there's multifamily residential, medical office, a bunch of other, subsectors, and geographic diversification is also key. So where do we like real estate? We like industrial and multifamily, and that's where we've been. Most of the damage has been done primarily in office and some hospitality. And that stuff has just got to work through the system. And it will help a lot if the Federal Reserve starts lowering interest rates. It'll take a lot of the pressure off some of these assets. And it's not likely they're going to raise interest rates. Not likely they're going to keep them at 5.5 for an extended period of time beyond the second half of next year. So as a result, patience is required in real estate investing. Patience is required in any alternative investment. When you buy an alternative, you got to know it's a 5 to 10 year lockup. You don't want your money back, because if you want it back that badly, you're going to have to force sell something in a distressed market. So don't let the manager work it out. That's what I would say. Julian?
If we have time for a final question, it's almost 90 minutes, but maybe just one last on gold and Bitcoin. Where do they fit in a portfolio?
That's the last question you pick for me, is gold and Bitcoin. I think we could probably find one that is more relevant to our investment strategy. Gold and Bitcoin, they're not the same things, by the way. And neither one of them has a strategic, and rarely, if ever, rarely has a cyclical place in the portfolios. Gold, because it trades on either real yields, which it didn't trade like that, or geopolitical risks or things. I mean, it's very hard to know where gold is trading from an intrinsic value perspective. Bitcoin, it's impossible. So cryptocurrencies, just, they're trading assets. If you want to trade them, have, teeny tiny little bit, but they're not a retirement asset per se, because you can't identify their valuation metrics. You don't know. I think investments need one specific feature to be an investment. They have to have an intrinsic value that you can look at. Bonds have intrinsic value because they have cash flows. Stocks have intrinsic value because they pay dividends. Alternative investments are just stocks and bonds repackaged as in illiquid investment vehicles. So I understand all of those things. But until someone presents a cohesive, theoretical valuation framework for, both gold and crypto, but mostly crypto, gold at least has got a 5,000-year history of being, a place to store money in times of crisis, but it doesn't have a high rate of return. So just leave those out. Buy the stuff that, like infrastructure. If you want a real asset, infrastructure is a good place to be. Commodities a little less so because they're very highly volatile, but it's not a bad spot. So if you're looking for real assets, tips during certain periods, infrastructure, and to a lesser extent, commodities are a better place than, in my opinion, simply precious metals or gold in particular, and something I don't understand how it trades, mostly technical, supply and demand, crypto. That's what I would say. If that's it, I hope there's one. No, that's it. We're at 90 minutes. So
yeah, I think it's time to wrap it up. Just I'll answer one question, which was about where we find the book. So the book is not available for download on our website, but the video, the recording of the video and the slides are available. If you watch the video, that'll be posted on the Bitcoin Point website. So on that note, thank you, Michael, and everyone. Please look out for our invitation in your email inboxes for our next quarterly macro and market update that will take place on August 15. See you all next month. À bientôt.